Welcome back to Power Lunch. Markets are starting the last trading week of September with a whimper. The S&P and NASDAQ are pacing for their worst month since December of 2022. And things could get worse before they get better between the labor strikes, the looming government shutdown, and the likelihood of rates staying higher for longer. So where should investors turn? Let's ask Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower, as well as a CNBC contributor. Stephanie, good to see you. Does the recent stock slide have you drooling or concerned?
Well, we are getting some opportunities, Cal. I know we're going to get to that in a little bit, but September basically is a very volatile month. It's living up to its billing this year, right? We're down about 6% from the highs. The VIX is up 34% in 2 weeks' time. And you just cited a lot of the reasons are there's a multiple of issues, right? You have the unknowns of the Fed. You have the labor strikes. You have oil prices are up 32% from the June lows. You have the government shutdown, which is a big looming situation. I think it'll be short-lived, but it's another uncertainty. And of course, I think the biggest thing is you have the 10-year yields are inching higher at 4.6%. You're at new cycle highs. And so as rates go higher, that's competition for stocks. So I'm not surprised we've seen this kind of choppiness and this trade down. I think better things are ahead for us, though, because I think the economy is hanging in there much better than most people expected.
The economy looks good. The consumer is reasonably healthy. But those high and rising and higher for longer interest rates, what does that mean? What does that spell for stocks over the next 6 to 12 months?
Yeah, I think it's a challenge, Tyler, because for the last 10 years, there was no alternative to stocks. Right now, you have all kinds of alternatives, not only in fixed income, but cash. The good news is that over the long term, stocks actually, the total return outperform bonds handedly. About 7.7% on average total return over the long term. And so that compares to about 3.5% for fixed income. So I'm not saying you don't want to have a diversification. I'm not even saying you don't want to have cash. I think you want to have all three. But I do think that stocks follow profits. And I think that we've seen a trough in profits. And I think you're going to see companies that are going to be able to handle the higher prices, but also they're going to be able to price increase as well as cut costs. And the demand side of the equation is better than expected.
Can I ask you, Steph, about Nike? And I love that in your note it just says gulp. and I remember I was thinking about this morning as well. I remember when we used to talk about Starbucks all of the time. I mean, some of these were some of the best beneficiaries of the 2010s and of China. And I think of both of them now and really ponder kind of what their earnings power looks like in whatever this kind of new normal world is.
I still think, Kel, that Nike's earnings power is something close to $6, $6.50 in the next 2 years. And a lot of that is predicated on them getting back to high teens EBIT margins. And how are they from 11% today? How are they going to do that? Well, a lot of it has to do with lower freight costs, lower input costs. We'll see about currency. That's a wild card. But most importantly, inventories. Inventories improving. And so then you also mentioned China. I think China, the consumer in China, is actually doing better than expected. Remember, we got a really good industrial production and retail sales in China 2 weeks ago. And so I think the consumer is doing better. That's 13% of Nike's revenues. I also like the DTC movement. That's going to help margins as well. So it's choppy, dicey now. It's not super cheap at 23 times forward, but certainly down from 28 times for its 10-year average. And so I'm hanging with it. I like best of breed on sale. I think this is what it is.
It's a week for Nike. It's a week for Micron. We're going to hear more about China and more about a lot of these factors, but I love the way you explained the challenge Nike has ahead. Stephanie, as always, thanks so much for your time today.